Welcome to the video series on Warren Buffett shareholder letters. Today we are going to talk through 1963 partnership letter which Warren Buffett wrote. Now, before going into the details of key takeaways from that letter, if you're watching this video for the first time, what I would recommend is go back and have a look at our introduction video. That talks through what we want to cover in this video series. Now over to the letter which I've got with me here. What I really want you to take today is 8 key takeaways from 1963 partnership letter, and I'll quickly jump to the first one. Now the first one which caught my attention in 1963 letter was Warren Buffett's outlook and his opinion on fluctuation of daily stock prices. Now he clearly spelled out that he is not looking at a short-term view of what market thinks about companies, and that's not his job. And what he wanted to do was to create value over long term. So that is a very key and important lesson that as a retail investors we should take in. Imagine if you are viewing your portfolio on a daily basis, because of this constant monitoring of equity prices, you would tend to get into a habit of activity where you will buy and sell things continuously. That's A is going to fill your broker's pockets, and B is going to make you a short-term trader rather than a value investor. So that was one of the key takeaways which we got from the 1963 letter. The second thing was around his take on tax and its impacts on investing. Now, how many of us actually wait for an year end to make a sale because we think that we might have to pay extra tax to the government, and we should actually do a sale in the next financial year to save on some taxes. Now that's not entirely a correct thing to do. What you should look at is what is your best compounded after tax return, because that was the focus of Warren Buffett while running his partnership, and that should be a clear focus for us as well when we are investing and making buying and sell decisions. It's always good to understand the best tax structure that you can give it to your investment, but don't make tax as the sole criteria of making a buying or selling decision. So that was one of the key things which we got from this 1963 letter. What Warren Buffett also did in 1963 letter was he took a pot shot at the mutual fund industry. And as you would know that right throughout his letters, not only he did compare his performance to Dow Jones, but he also compared the partnership's performance against a few of the largest mutual funds which were there in the US at that time. And he actually pointed out one reason why mutual funds were not able to consistently beat even Dow, leave alone his own partnership. And I would tend to quote him from the letter. He says that, and hear it out, he says that to behave unconventionally within this framework, and when he talks about this framework is the framework within which the mutual funds operate, it is extremely difficult. So what he's trying to say, that if you don't behave unconventionally, if you go with the herd, if everybody is buying and you go and buy things, if everybody is selling, you go and sell things, you're not going to make market beating returns. You'll still be getting the average market returns. So we need to be a little unconventional. We need to be greedy when people are fearful, and we need to be fearful when people are greedy. That was really clearly visible in this 1963 letter. The next part, the next key takeaway was very important from an investor's perspective. Not that the others were not, but in the next section, Warren Buffett actually talked about what did he see in businesses before acquiring them. Now we can really nail down and understand, because there were details which he talked about, which he saw in businesses before investing in them, and I'll quickly jump onto that one. Now he was talking in context of generally undervalued securities, and what would be the features of an undervalued securities. And if you look at those features, and when you find a parallel security trading with similar features, you're bound to make a good buy. in those securities. So let's hear out from the great man himself what he was trying to say in terms of qualities of generals which he would look into. So he says that these securities lack glamour or market sponsorship, so they're not market darlings. Their main qualification was they are available at a bargain price. That means they were available at very significant discount to their instinct value. And when he talk about this bargain price, his outlook was what would be the value of that company to a private buyer, because he used that as a criteria to understand if the security was undervalued or not. And importantly, he had two more points to add. He was saying that although he put in a lot of emphasis on the quantitative factors before evaluating whether to buy or not a stock, he always paid attention to the qualitative factors. When he talks about qualitative factors, he was referring to the kind of management the company had. He also talks about what kind of industry the company operates in. So those were the qualitative factors that he looked in. So principally 5 factors which we got from his letter that he looked in before he was attempting to buy any good general issues which was available in the market at that point of time. The other thing which we got from this letter was his reasoning of why a workout portfolio. Remember workouts which are dependent on a corporate action. He always believed that workout situations were reasonably insulated or risk free from what's happening in the outside market, because they were very company specific events. And even though the margin was really thin on the workout situations, overall if you do 10 to 12 or 15 workouts over a year, your returns look pretty good. And in years where market was really not doing anything, that would tend to be in your favor. So that was another thing which we got from this letter. Now, one of the interesting things which we got from this letter was a concept called as idea inventory. Now, what is idea inventory? Idea inventory is, as a stock market investor, you constantly are looking out for next investment opportunity. And there is a very beautiful line in the letter where he says that our idea inventory has always seemed to be 10% ahead of our bank account. So you've got some money in your bank, but you need ideas to invest, and you need profitable ideas to invest. So it's a very, very important concept as an investor. Be whatever is the market situation, you should be in lookout for new ideas. There will be always a small company or a large company which has gone out of favor or which is not under the spotlight. You will be able to find that only if you're in constant lookout for inventory ideas. And again, now last two things, and this is perhaps would take the longer part of the video today, were two important case studies on. One was a workout situation, the other one was a control situation, and Warren Buffett did put them in appendix and gave a very detailed outlook of how the operation happened on that particular issue and how did they make money on those two ideas. Now, the first case study was on the Texas National Petroleum, and this was a workout situation where the company was going to be acquired by a larger company. Warren Buffett invested in the debentures as well as the equity of the company. Now, what was the most important thing for me in this case study was a clear indication from Warren Buffett that on this workout situations, he would rather wait for official communication from the company to come out in papers before going and pouncing on the opportunity. Because a lot of times what we find in general stock market is people go on news items which are basically nothing but rumors, and you hear that someone is going to take over XYZ, and then you go in and buy XYZ because generally when a large company is taking over a small company, you'll have a price appreciation with the expectation that the acquirer has to pay up to the shareholders of the small company. Now that was not Warren Buffett's style. What he wanted to do was always wait for the official communication and then look in and then buy the company for his workout situation. Now he talks at great length about what was initial hypothesis was on this workout, and another key lesson he was trying to share in this workout was that the workout took a time gap of what was more than what he expected it to be, and that happens with the workouts. You were hoping for a spin-off to happen in 3 months. That might take 4 months because of regulatory hurdles or because of regulatory permissions or something else. So if you are committed to a workout situation, always be a little patient. Otherwise, you would not tend to get the return that you have envisaged when you got into that workout situation. The second case study was on Dempster. So expected, because they were one of the control stakeholders. They were able to turn around the company, and again, if you look at, there were a lot of things that we could have learned from this case study. First thing was the buying price. See, the buying price was so attractive for Warren Buffett that even a mediocre sale would have made it really good. Look at the situation where he bought this company. The company was trading at $18, while it had almost $50 in cash, receivables, and inventory. So look at the situation here. He is buying a company which has more cash, inventory, and receivables than the current stock price. Now, is it possible to find such companies in today's market? Maybe very rarely. But look at the kind of margin of safety that this guy had on this particular investment. Now that talks about the quantitative side of things. At the qualitative level, what he has put is that the management was an issue with Dempster, and they were operating in a tough industry. So he thought if we can change management, he would be able to bring back the earning power of the company. That will also enhance the operating value of the company. Not only the things which it had in non-operating space, even the operating space would increase in value. Now, if you get into a situation where the quantitative factors, and this is what he calls out in this case study, is where the quantitative factors are really attractive, where you're getting a company which is selling less than the cash it is holding in its book. Until unless it's a fraud situation, in 70 to 80% of times you're going to make money on that investment, and so did Warren Buffett on this particular company. Now, the second set of learnings which we got from this case studies was how the new CEO which was hired, which was Mr. Harry Bottle, was able to turn around the company. So again, when you are evaluating a company which was doing well and has suddenly gone down, look at few important things to see if a turnaround for that company is happening. Now what Harry Bottle did was he reduced inventory significantly. So if you see inventory turnover improving for a company, you know that things are going right for that company, until unless if they are doing liquidation sale. The second thing was he freed up working capital and fixed capital. So if you see the fixed capital turnover increasing, or if you see the working capital turnover is increasing, again something positive is happening for the company. And for your established companies in the portfolio, if reverse is happening, you know something is not going right. But again, you have to judge for a period of length. You can't just on a quarterly basis. You need to give a year or two to see if things are really changing for the company. Now the other thing which the CEO did was he cut the overhead and administration cost again, and he also what additionally he did, he cleared off branches which were not profitable. So he was really weeding out the problem areas of the company. And again, if you see a similar example which is happening to a company in front of your eyes, you can understand that the restructuring and the things which are happening in the company are really going to show up in value, because that's what happened in the case of Dempster, wherein they were able to realize a very high value. They started investing at about $25-30 a share, and within 20 months they were able to sell out at $80. Why? Because they were able to change management and they were able to get things like this done. Now what happens is when you improve the fixed asset turnover, you improve the working capital turnover, you take care of the inventory, you take care of the account receivable, your earning power improves, right? And when your earning powers improves, people are ready to pay more money for your operating assets, and that's what happened in the case of Dempster. So very key lessons that we got from both case studies, one which was on workout, the other one which was on which was a pure control situation. Those were our key 8 learnings which we got from the 1963 letter. Hope you got all the key messages. Now you're going to go back and read the letter. If you have additional insights, do share in the comments of the video. Do hit the subscribe button. We're going to get you more videos, more shareholder letters in future months. Thanks for watching, and I'll see you again